When chasing more dividends leaves you with less cash. Got to talk about this, my friends. This is an issue. And in fact, it's one of the things I learned from my options trading strategy, writing covered calls back in the, 2000? Yeah, 99, 2000. When you're chasing high yields, high dividends, high income, there's a good chance it can be left with a lot less. So I get a lot of emails about SCHD, for instance, and we're going to talk even beyond SCHD. We're going to go into this right here. My man Jason Zweig over at the Wall Street Journal had written this back in September 6, 2024. He starts right here. Although funds with big payouts sound safe, high income can lead to a poor outcome. You need to guard against needless tax bills, overexposure to narrow segments of the market, and the chance of deep long-run losses. Deep long-run losses. I tell you, that's the thing with these buy right, which is basically selling covered call thing. High income can really rock your world, dude. And we're going to show you here an example. The appeal is obvious because dividend funds pay out high current income, typically monthly. They can be somewhat less risky than the overall market. You're going to seem that way. Unlike typical interest payments from bonds, dividends can grow over time, helping hedge against inflation. And during the long period of near zero interest rates that began in 2008, many investors got used to the notion that stocks can generate higher income than bonds. Yep. In fact, he says right here, that was in fact the historical norm until the 1950s. And then now we just don't even pay dividends. We just buy back shares is what they do essentially. You got to look, I mean, the buyback of shares is legit use of your company's capital for sure. They're saying, hey, is our stock undervalued? Well, let's buy back the shares, man. I mean, you're trying to buy shares that are undervalued relative to the market as a whole. Buying back shares makes sense, or they could pay a dividend out. I actually like buying back shares. I got no qualm with that. But that's one of the reasons why the dividend payouts are so low relative to what they historically been, because they've been buying back shares. Nothing wrong with that at all. In fact, that turns, well, not anymore, but in the old days when a dividend was taxed as basically equivalent of ordinary income, a buyback of shares would be better because you turn ordinary income taxes on a dividend received as to long-term capital gain, which is taxed much, much, much more favorably. Now, long-term capital gains and qualified dividend income are taxed the same, so you can't really make the same argument. But I mean, I get it. It's buying back shares. It actually decreases the number of shares outstanding and gives you more potential for long-term capital appreciation for sure. But that's why the dividend rates are so low. So people say, I got to find something high dividend. And let's take a look here. This guy talks about the Global X Superdividend, which yield nearly 11% back at the time of this writing. So that's SDIV. Let's take a look at it now. SDIV is a ticker on that guy. SD, I'm going to type it in my trusty phone here, SDIV. And right now that guy's yielding 11.03%. 11.03%. You can see it right there. All right. Unfortunately, what happened with SDIV? Oh boy, is the price, it was initially issued at $75 a share and has gone down to $22 now, right here. The Super Dividends Fund Supersized Yield comes at a cost. Launched in June 2011 at $75, it traded for $22 back in September 2004. That's a 70% decline. In fact, right now it's trading at $21.30. It's down $50 from its all-time high. That's a 70% decline. If you'd bought the ETF at inception and held continuously throughout the end of August, you'd have lost 9%. In fact, let's take a look now. Oh, and that does account for the super jumbo dividends you've received. So let's take a look at this. We're going to look at the Schwab SCHD, because I hear a lot of stuff about the Schwab Dividend Fund, which is, I think it's yielding like 3.5 right now or something like that. And that's not the same as this one. Don't get me wrong. Look, I like SCHD. When I'm saying the U.S. Dividend Equity Fund, I hear a lot about this fund. Right now it's at 3.57. All right, so the Schwab U.S. Dividend Equity Fund yields 3.57, and then the VTI, just for instance, the total stock market is yielding 1.23. So basically 3 times the dividend yield for SCHD than the VTI. All right, then this guy right here, the SDIV, was yielding 11%. Significantly higher than that. So you can see right here, we're going to use these 3 tickers: Schwab, Vanguard, Total Stock Index, and then the SDIV Global X Super Dividend. And we're going to put $10,000 in. This only goes back to 2011. And we're going to see what has returned most. You can see right here, blue is VTI, which is our hero. That's $10,000 invested in 2011 is worth basically 60,000 now. The Schwab is worth 50,000, and the super dividend is worth all of 10,000. So you made no money in super dividend. You've quadrupled your money. No, you quintupled your money in SEHD. And I don't know what 6 times. It was sextupled. I don't know. I don't like to use the word sex because it sounds very risque. Woo, sextupled. How dare you? I don't even know that's the right word, but we're going to run with it because it's fun to say. I sextupled my gains. So we see that. So you can see the total returns on this total right here. The compounded annual growth rate in the Schwab is 12.81. The hero VTI is 14.31, and the other one was negative. So he made no money after 10 years. You literally made no money. So now let's say if we put this, let's say we took 500, we're going to take 5% a year out. All right, so we're going to draw a fixed amount, $500 a year. That's 5% a year, and we're going to adjust that with inflation. And let's see what these numbers shake out to be, shall we? Boink. We're going to boink it. Man, I'm saying boink and sextuplet. Jeez, get your head out of the gutter, Josh. Oh, my goodness. Get your head out of the gutter. And after our live stream that we did last Saturday, where there's a bunch of boys sitting around the locker room, essentially, and a couple of ladies to keep us on track. I think we had Angie, Penelope, Marie, and I don't know if we had any others that were at least commenting. Not many others, but those ladies kept us on track. But otherwise, basically, it's a boys' night out without drinking, because we like women, so we don't drink. Because if you like to drink, you obviously don't like the ladies. All right, so in this case, we're taking 5% a year adjusted with inflation, and our hero still comes out on top. $40,000 is the net asset value, the net amount after 2000, basically 15 years. 33 for the Schwab, and then 3,000 for the global fund. So you just got spanked, dude. The global fund got spanked. Schwab, not nearly as rate of return. I mean, he still made money, 9.57 versus 11.12 versus getting crushed in the other fund. All right, so now let's just say we're going to live off our dividends alone, and we're going to say we're not going to take any money out. All right, we're just going to live off our dividends alone. I'm starting to get that guy Morgan Wallen. Can never believe I'd actually get into that, but kind of dig that guy, dude. Kind of digging that guy. So now we're not going to reinvest dividends, unless we're just going to spend the dividends. All right, so let's see what we come up with here. Let's see what we got. If y'all like Morgan Wallen, smash that like button. Oof. Oh, man. If we didn't reinvest dividends, Schwab gives us 9.36. Vanguard, our superhero, gives us 12.29. And the other fund just got destroyed. So, yeah, I mean, and look, the difference between Schwab at, what is that, 12.29. We're just going to say basically 300 basis points. So 3% divided by 9 point, we'll just say what we're going to do, 12.29 minus 9.36 equals 2.93 divided by 12.29. That's a 22% increase for VTI when you don't reinvest dividends. I mean, look, we've had such a magical last 15 years. I can't lie to you. Will that happen again? Man, I have no idea. But when you're reaching for yield, that can be what happens. I mean, we can look at the same thing. We'll get rid of this fund. We'll just put VDIGX. That's a Vanguard one, VDIGX, and that will do the same thing. And Portfolio Visualizer, what happened to you? This only goes back to 2011. Portfolio Visualizer used to go back to even longer than that. It's fantastic. Yeah, it's VDIGX, the Vanguard Dividend Growth Fund, 7.02. I mean, that's taking dividends off. What if we reinvested dividends and we took $500, a 5% amount each and every year? Again, I mean, I can't guarantee it's going to happen. I have no clue, but this is a problem, dude. Is that the dividend funds, when you're reaching for dividends, you're kind of, what's the word I'm looking for? In banking, we call it disintermediation. We're basically using our bank money to invest. We're basically eating ourselves, if that makes sense. That's kind of what we're doing here. We're smoking our product. All right, what we're trying to sell, we're smoking instead. And so if we go back here to the dividend growth fund, got 9.1. This is taking 5% a year off. Our VTI is up 11.12 and 9.57. So you can see, VTI still is a hero. And again, could that be the 15-year record that was just fantastic? It might well be. I don't know. And then you got to look at it from an income stream, annual returns. Oh, see, this doesn't give us income. I wish it did. I mean, at the end of the day, you're making less income. I don't think it does show us income. Yeah. Portfolio visualizer. How I miss you. Oh, maybe it does. Income, returns, allocation, driven metrics, and returns. Let's see. Yeah, I don't think it's going to give us the income. Dag nabbers. Nabbers, dag it. Metrics. But anyway, it's just tough to beat growing dividends on you're starting lower, I grant you, but at the end of the day, most likely it's going to be tough to beat just a good old-fashioned broad-based index fund. It's going to be tough. I'm not saying it can't happen, but it's going to be tough. All right. Love your thoughts. Smash that like button. God bless. We'll see you.